Hi, welcome back to the channel. My name is Dave, and today we're talking naked call options. Pretty exciting, I know. You know, when I think about naked call options, I kind of think about my credit card that I use every single day or a week. I charge a bunch of stuff to it at the end of the month. I'm really responsible. I pay it all off. And for that, they give me some points. In my case, it's airline miles, and I fly places for free. It works out great. Now, naked call options are kind of the same thing. If used responsibly, it'll save you some money. So for me, it saves me a couple $1,000s. I can fly all kinds of places with a couple $1,000s. So use the right way. It's a great way to save some money. I'll show you exactly how you can do that with very little risk. Now, there are also some really risky ways to use naked call options. We'll talk about that as well. So if you want to get naked with me, wait, that's not right. If you want to watch this video and support the channel, please stick around. Whoop. So first off, if you're brand new to options and you can't sit there and explain to your buddy how to buy and sell puts and calls and the principles behind it, you shouldn't have this even turned on in your account. Now, once you're ready and you feel comfortable with it, you'll probably have to call your broker in order to turn it on. They're going to want to know what kind of experience you have, how long have you been trading options, what's your account value, that kind of thing. And then once you can convince them, they'll turn it on. But understand there's a lot more risk involved with this. You know, a mouse slip and suddenly you lose a couple $1,000s. That's what they're trying to protect us from. So it's there for a good reason. It's buried a little bit. So just understand that. If you don't see it in your account, you'll probably have to talk to your broker. The other principle you should clearly understand is short selling. So I like to think of short selling as an IOU, right, to your broker. So let's say stock XYZ is at $100 a share and you short sell 100 shares, say minus 100. Then let's say it goes down to 70. Well, now you get to buy it at 70 to make yourself even. You give it back to them at 100, right? So you would make the profit from buying at 70 and selling at 100. But if the stock goes up to, let's say, 200, has an outstanding week like we've had, there's a big recovery, goes all the way to 200. Well, now you have to buy it at 200 and sell it back to them at 100. You lost 100% of what you invested, and you could even lose more. So you have to understand that principle just because that's what it's involving, right? So when you're selling naked, you don't have the shares. So you have to understand that principle. So make sure you can explain that to your buddy as well. So now let's define selling a naked call. So traditionally, we're going to sell a covered call. That's probably the one that everybody gets familiar with first, right? So let's say you got stock XYZ at 100. You go out and you buy 100 shares and you sell the $105 covered call. You collect your premium for selling that and you put it in your pocket. Then we wonder, see what happens, right? Stock goes sideways and expires, or down and expires, or it goes up. So let's say it goes up towards that 105, goes to 106, 107. Well, at expiration, because it's at 107, they get to call it away from you at $105 per share. So they're happy, but you're happy too. You actually both won because you bought it at 100 and you sold it at 105. So you made $500 plus your premium. Off to a good start, right? So that's selling covered call. And that's kind of the traditional way. But maybe you don't have the time to go out and buy those 100 shares and you just don't believe it's going to, who cares? So you're going to sell a naked call in this case. So in this case, you just don't buy the shares. You just sell the naked call, right? So stock XYZ is at 100. Sell the naked call at 105. You collect your premium, put it in your pocket, and we see what happens. Trades sideways or goes down and expires. Yay, you did a great job. You got your premium. But if it goes back up to 105, 106, 107, maybe it goes all the way to 115 for all we know. Well, now you're short shares, right? At expiration, you don't have the shares, so now you're in a short position. So it goes to 115, and you have to buy it at 115 and essentially sell it at 105. So you lose $1,000, but you got your premium, so maybe you're down $900. That's the idea of selling a naked call, and that's, you can see the ramification there if the stock starts taking off. So that's kind of the definition and how the mechanics work of selling a naked call. So now that we have this all defined, how does this actually save me a couple $1,000s in my mind here? So you've got two options as you approach expiration. So let's say Friday's coming up. It's Friday morning. I look at my bunch of options that I've got here. Some are in the money, at the money, or way out of the money. The ones that are way out of the money, right? You have two options here. One, you can wait for expiration Friday night. You can sell your next call option on Monday. That is an option, but you're losing time, right? You're losing theta. Well, it just sits there and does nothing. The other option is you can buy to close, sell to open, which is rolling our option, right? So let's say you want to roll it, you're going to get $100 for your new option, but it's going to cost you, let's say, $3 to close that option. That means you make $97. But with having a naked call option available to you, you don't have to close it and you don't have to wait. You can just sell your next call option. And in doing so, I get to collect my extra theta. and I also don't have to buy to close. And here's an example of this with AT&T. I do this every single week. I've got 4,000 shares of AT&T. I can't really shake them, but I kind of like it now that they're split up. I like the dividend. So I sell an out of the money call far enough out to collect about 5 or 6%. Combined with the dividend, it gives me a nice little return if it would just stop going down. So I'm hanging on to these 4,000 shares. I've had them for years now. And, this is a good example because 10 contracts would cost me $10 to close plus change every single week. So in doing this, instead of selling, even though it's a covered call in the sense that I've got the 4,000 shares on Friday, I can sell a naked call for a few hours and keep my extra $10. Over time, that adds up to be quite a bit. So a great example, especially if you're selling inexpensive stocks and lots of contracts, it will add up quickly. And just to explain this in a little more detail, AT&T is now worth $19.80. So it's nowhere near this $20.50 call price. And as Friday rolled around, which was the expiration, right? We've got an expiration of May 13th. I did this back on 4/18. So when I did this, I collected $173.20. That's what I got to put in my pocket. That was my premium. But time ticked away. AT&T didn't come anywhere near that $20.50. It's like $19.80, like I said. So I've collected the vast majority of this, 94%. I'm not going to be able to collect any more because it's a minimum of $1 to close a contract. So having this ability to just sell my next naked call allows me to not have to worry about closing this out and spending that $10 and change. So it's a nice advantage for me. And of course, this also works with puts. So if you're a seller of puts like me, let's take, for example, that stock XYZ again, right? So you sell a put on stock XYZ. When it's at 100, you sell the $95 put out 2 weeks. Time starts ticking away. We get close to that expiration date, and it's dropped all the way down to $88 a share. So what are your options? Well, it's at $88 a share. Friday rolls around. If you can sell a naked call, I would do it then, right? Because now I get to collect that extra theta. If not, you're going to wait for assignment. Let's say, and I'm assuming you want to take assignment of these shares. Otherwise, on Monday, you got to wait, right, until that comes around. And on Monday, now you're going to sell it as a covered call. But you're essentially doing the same thing on Friday. You're collecting a little extra theta. We don't know what's happening over the course of the weekend, but we know time is what we're selling. We're selling theta as sellers of puts and calls. So that is, in my mind, a relatively risk-free way to use naked call options. Put a few extra bucks in your pocket, just like that credit card. It's risk-free. I feel like it's a no-brainer in many ways for me to have this and trade this way. Now, I'll admit, in this crazy stock market recently, I've been getting more aggressive. I've been selling that second call, naked essentially, earlier in the week, maybe even the previous week. It just depends. But I'm paying a lot of attention to the market. I'm watching it every day, multiple times. I'm watching the stocks, waiting for news. So if you decide to do this and move it away from that expiration date, maybe Thursday, Wednesday, Tuesday, Monday, then you definitely want to start looking at your option chain, paying attention to your deltas, and making sure that you feel comfortable with this trade. You really need to define your own risk profile and see how far you're willing to go with this, because you could get pinched, right? We've seen stocks in this current market really revert quickly, like on Friday. So you're trading that crazy tech sector, some of these smaller stocks that are all over the place, their betas are nuts. Well, you have to be ready for that to revert in the wrong direction and for you to be suddenly in a bad short position. So consider that before you go start trading and going, oh, well, I saw it on this channel. This is a great way to go about it. I'm not saying do that. I'm saying take the few extra $1,000 or whatever you can get by having this in your account, but be wary of getting too involved with it and thinking that it couldn't possibly happen. As soon as you think that, guess what? It's going to happen. For example, you want to define your risk, right? So this is an option chain for Apple. It's at 147.11. But if you wanted to go out there and sell a call option right now at the 165 range, you're looking at a 2% delta, 2% chance of it expiring in the money. So you can feel pretty good about that. So maybe you should go trade, 50 naked call options against it. That's what I don't want to see. I don't want anybody to get overly confident and never say it can never happen, because as soon as you say that, guess what? It will happen. But if you decide to take on some additional risk and maybe move this back earlier in the week and sell that second option or that third one, define your risk, make sure you understand the ups and downs. So definitely consider it all before you click confirm trade. So naked call options. I think they're a great way to enhance your portfolio. It's just like that credit card. Put a few extra bucks in your pocket. Or I guess when you go to the steakhouse and you get it Oscar style, I like that too. Steak, Oscar style, right? It's an enhancement. And when used properly, it's really simple. There's not a lot of risk with it. But when used improperly or you don't understand it, there's a lot of risk involved. So make sure you're clear on how this all works. Now, if you have any questions on any of it at all, please ask down below, email me or whatever. Thank you for getting naked with me, and we'll see you next time. Have a great night.